been a very difficult period for the apparel space with the ridiculously warm weather, making it so retailers simply don't have the merchandise that consumers are looking for. They've got lots of winter clothes, but that doesn't help much when the temperature's staying in the mid-50s all week. However, some apparel companies are doing better than you think. Take PVH, the global clothing powerhouse behind Calvin Klein, Tommy Hilfiger, some smaller legacy brands. PVH just reported after the close today, and the company delivered a 19-cent earnings beat off of a $2.47 basis with higher than expected sales. Those were some good numbers. The guidance for the next quarter pre-mix, company forecasting much higher than expected sales, but some would say weaker than expected earnings, with the pain in the latter mostly coming from that strong dollar because of PVH's vast international business and some lower domestic traffic. Still, the big takeaway here is that these results were better than people feared. So let's take a closer look with Manny Chirico. He's the chairman and CEO of PVH. Hear more about the quarter and his company's prospects. Mr. Chirico, welcome back to Mad Money.
Thanks a lot,
Good to see you, Manny.
Good to see you.
Have a seat. Manny, I don't know what to do. I mean, here you go. You got the terrible weather. You got this dollar. I have to look at the numbers. I say Calvin Klein up 7%. That's really pretty fabulous, but it's a constant currency basis. Yes. Tommy Hilfiger up 4%, constant currency. These are terrific numbers, but you've got this whole thing with the currency that we can't get rid of. And now you've got the weather. What is a retailer to do? What is an apparel guy like you to do?
Look, I think you have to focus on the underlying business. Okay. What's really going on? I think you hit some of the key numbers and really looking how the business is performing overall. We are facing some headwinds. You talked about currency, and that's going to be with us for another 12 months as our hedges start to wind down and we have to be up against the volatility and the strengthening of the dollar. And then you talked about, look, this is the apparel industry, so part of what we deal with is fashion risk, part of what we deal with is the weather and what goes on. Those are things that I'm 20 years in the business, those are things that we're used to managing through, and I think we did a great job of managing through it in the third quarter, and we'll get through it in the fourth quarter. The challenge right now in the fourth quarter is inventories is built. You've heard everybody talk about it. It's more promotional. So although we had this fantastic third quarter, we just weren't confident to really bring up the year at this point. But I think overall, given the macro environment and what's going on, I'm really satisfied with how the underlying business is.
You have to be, and I think you have to be impressed. I don't know, when I look at the quarter, I think Europe's better than the U.S.
Well, right now, for sure.
It is.
I mean, the Tommy comps were 10% in Europe.
Okay, but let's think about this. Here we got their Federal Reserve guy, Mario Draghi. He's saying things aren't that good. They got to continue to ease, and yet their economy is better for yours than us.
Yeah, there's a lot of variables in that, but across the board in Europe, market by market, both for our Calvin Klein business and our Tommy Hilfiger business, right now that's the strongest market we've had. Following the Paris tragedy that went on, there was a lull in business for about 7 days, and it seems like business has come back now post that. But we had a very strong third quarter, and it's just continued into the fourth quarter. So Europe is very strong. We start to look across the world. China continues to perform for us. The rest of Asia, Hong Kong, Korea, under more pressure. South America, the underlying business, Latin America doing really well, dealing with the currency issues of Brazil. And then you come to the U.S., and the U.S. is it's probably our toughest market right now.
Isn't that something? All the years that we've been together, it's always the U.S.'s shine. Now, this is good because it shows that the diversification overseas, which some questions, was dead right. I want to talk about China for a second. A lot of people think, oh, China's doing badly, but that's steel, that's copper, the Chinese consumer herself, she's spending more than ever.
Well, she is. I think it depends where you sit in the market. Okay. I think if you're sitting on the luxury end of the market, you're really struggling right now.
Right, the government doesn't want that.
Exactly, and I think there's pressure at those prices. Where both Calvin and Tommy sit, we're at the premium point in the market, and I think we've got a lot of improvements in the base business, and we've seen that business both for Calvin and Tommy continue to grow for us and healthy comps and continue to really perform for us.
Now, one of the points you point out, and I think that it's not just the strong dollar translation, but you mentioned that domestically, tourists.
Well, when you're running two global powerhouse brands like Calvin and Tommy, over the last 6 to 7 years, as we've continued to invest in those businesses, one area where we've really outperformed is domestically in international markets domestically. New York, Miami, L.A. At that time, the weakening dollar. Right. it really attracted an international consumer that really is not coming here to the same degree, particularly South American consumer, Brazil in particular,
right,
which is a huge market for us. We had big business there. And Europe and China right now, just we don't see the tourism that we had in the past. And I think you see it in a lot of luxury brands, from Tiffany to even Terry Lundgren, I know, has been speaking. He talks about his Herald Square store, which is the largest department store in the world, really being under pressure because the international tourist isn't here to the same degree.
It is amazing. Now, Manny, where's the mall in your thinking? I mean, your stores that you sell in malls versus out. You know, there's this death of mall theory that is really going around. Can you shoot it down?
No, I can't shoot it down completely. I think the issue that's going on is there are too many stores in America, and I don't know if that's 10% or 15%.
So
but 85%
says we're overstored.
Yes, we're overstored, but 85% of the business that we're doing is brick and mortar. And I don't know in 3 years if that'll become 80%, but it's going to continue to be a lion's share of the business. But there's no doubt that not only the fact that there are so many stores, but that there's a continuation of building new and stronger, more stores and new entrants into the market. Brick and mortar is under pressure. We just came through our November Black Friday week, and what we saw is brick and mortar was soft, okay, but our e-commerce direct-to-consumer business, both direct that we operate and third-party direct, meaning Macy's.com and some of our other key those businesses were thriving. So, look, the consumer's moving. We have to move with them. We continue to make those investments, and I think there'll be a period of time that you'll see a contraction in brick and mortar stores overall, but it will continue to be 75–80% of the volume that's done at retail.
Well, I'm wishing you a weak dollar and some cold weather, because I bet you the numbers would be unbelievable if we got those. All right, thank you so much, Manny, Chairman, CEO of PVH, delivering another great quarter in a very tough environment. Mad Money's back in. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.